At the start of the year, I always do an exciting video series centered around stock picks for the year. I started with 10 top growth stocks, then I went to 10 dividend stocks, and ended with 5 ETF picks for 2025. But when it comes to actually managing our portfolio, the stocks that we invest in at the beginning of the year, we're not forced to hold them all the way throughout the year. We're able to adapt to a changing economy, a changing market. As such, in today's video, we're going to take a look back at my 10 top growth stocks for 2025, and we're either going to keep those 10 positions or we're going to replace a few of those positions. So make sure you stay tuned throughout the entirety of this video. And before we dive in, do me a huge favor by simply clicking that like button down below, as it really helps with the growth of the channel. Also, subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is Fiscal AI. Fiscal AI isn't just any sponsor. They are what I exclusively use whether I'm analyzing, valuing, or researching a stock in any shape or form. Whether I want to analyze the growth in revenues, look at operating margins, free cash flow, and so much more, or whether I want to dive into a number of different valuation metrics, both trailing and forward, I utilize Fiscal AI because it has it all. You can even look at segmented information. And for example, if you were analyzing shares of Spotify, you're probably interested in the subscriber growth they've had over the years. And as you can see here, you can create your own chart showing the growth in subscribers by year. Fiscal AI is a one-stop shop for all different types of investors, whether you're new to investing or you're a seasoned investor. And right now you can try their platform completely free and get 15% off any paid subscription moving on after that free trial. Just check out the link down in the description below. All right, now let's jump back into our video, first taking a look at the top 10 growth stocks that I mentioned at the start of the year, which included the likes of NVDA, AMD, Amazon, Uber, Alphabet, ASML, Micron, Caesars Entertainment, SentinelOne, and Block. Their year-to-date performance are as follows. NVIDIA, shares are up 28% on the year thus far. AMD up 30%. Amazon up 5%. Uber 51%. Alphabet's up just 0.4%. ASML's up 3%. Micron up 35%. Caesars is down 11%. SentinelOne is down 10%, and Block is down 8%. That is an average return of more than 12% had you equally invested across all 10 positions, which essentially doubles up the performance of the S&P 500 so far this year. But the big winners have been Uber, Micron, AMD, and NVIDIA. So now we're going to take a deeper look at all 10 of these positions, and I'm going to decide whether to keep them in our top 10 growth stocks for the second half of the year, or I'm going to choose to replace them. And I'm going to show you the stock I'm going to be replacing them with. So let's begin in the same order, beginning with stock number 1, which is going to be NVIDIA, stock ticker NVDA. And when we talk about AI, everything starts really with NVIDIA. They are the big AI elephant in the room. The AI sector tends to go the way of NVIDIA. And when it comes to risks for NVIDIA, there's a lot of hyperscalers that are beginning to build their own custom chips. That's more of a long-term risk. But in the short term, there's no one even close to the power and the speed of NVIDIA semiconductor chips. When it comes to NVIDIA, they operate out of the technology sector. They are the largest company in the S&P 500 with a $4.2 trillion market cap, and over the past 12 months, shares are up 38%. NVIDIA results have exploded in recent years, obviously with the growth in AI, but as you could see from this Fiscal AI chart, their revenues have exploded to nearly $150 billion. But so is their operating margins, reaching 62% just last year. Even if those margins were to come down a tad, those are still very strong margins. Looking at valuation, even with the growth the stock has seen year to date, shares still don't look all that bad. EV to EBITDA trades at 47.2 times, below their 5-year average of 60.2. From a forward PE multiple, shares trade at 35 times, again, below their 5-year average of 39 times. And with an EPS growth rate over the next 12 months around 40%, that gives the stock a PEG ratio below 1. These are all signs pointing towards a stock that I need to keep in my portfolio, and one that I believe could be pushing $200 per share by the end of 2025. And that's going to lead us to stock number 2, which is going to be Advanced Micro Devices, stock ticker AMD. We began with the big AI juggernaut, but one of the closest competitors to NVIDIA, if we can say there is one, is certainly going to be AMD. And for those of you that have been shareholders of AMD this year, it has been a roller coaster ride. AMD operates like NVIDIA out of the technology sector, but much, much smaller in size, with a market cap of just $255 billion. And over the past 12 months, shares are pretty much flat, up just 0.5%. So again, when you take a step back, the past 12 months haven't been all that great for AMD. It has definitely been a bumpy ride. But when you look at the sheer size of NVIDIA, that's where you can get excited as an AMD shareholder. There's plenty of upside. AMD does not have to surpass NVIDIA, but there's a huge gap between the two right now that could result in huge amounts of wealth being built over time. AMD revenues are up to $27.7 billion over the past 12 months, with EBITDA margins sitting in the low 20% range, with room to grow there as well. Analysts are looking for revenues to reach $38 billion next year and $44 billion the following year, so plenty of growth left in the pipeline. Looking at valuations here on this Fiscal AI chart, we can see that shares of AMD trade at an EV to EBITDA of 42.1 times, making it cheaper than NVIDIA from this perspective, and it is slightly below their 5-year average of 43.6 times. From a forward PE multiple, shares trade at 37.8 times, above the company's 5-year average of 33.3. EPS growth over the next 12 months is hovering around 35%, giving the stock a PEG ratio of just above 1, which is still pretty solid. So from a valuation perspective, shares still look all right, and there's still plenty of gap to close between them and NVIDIA. Earnings moving forward are going to be key, but for the second half of my top 10 growth stocks, I'm definitely leaving AMD on the list and letting it run. And that leads us to stock number 3 on the list, which is going to be Amazon, stock ticker AMZN. And you've heard me talk extensively about Amazon. I recently put out a video calling Amazon one of my favorite stocks for the next 5+ years. And some of the things I alluded to in that video was the diversified business. When we're talking about NVIDIA, it's kind of narrow in many ways. Now, they build the most powerful and speed chips that are out there, but when it comes to Amazon, they have advertising, retail, cloud, AI, and the list goes on. The company operates out of the consumer discretionary sector and one of the top 10 largest companies in the S&P 500 with a market cap of $2.4 trillion. And over the past 12 months, shares of Amazon have climbed 25%. Again, a very diversified business is one reason I love Amazon. But what we can see is a lot of the investments that the company has been making, and they've been sizable investments, are beginning to pay off. We continue to see growth in revenues climb, but we also are starting to see free cash flow. This is going to be a free cash flow juggernaut over the next 5+ years. Taking a look here at this chart, you can see free cash flow topped out at $32.9 billion last year. And 2 years prior to that, the company was actually operating at a negative free cash flow position. But look how much the company has been spending in capital expenditures, which goes into how we calculate free cash flow. They have spent $93 billion over the past 12 months alone. Had they spent what they did just last year, which is still way above what they have in prior years, we're talking again about near record free cash flow levels. Those investments are paying off as revenues continue to climb and EBITDA margins are reaching close to 20%. Looking at valuations here at this Fiscal AI chart, we could see shares of Amazon trade at an EV to EBITDA of 19.5 times, slightly below their 3-year average of 20.3 times. Again, I was pounding the table on Amazon when shares were trading at an EV to EBITDA around 16 times. From a forward PE multiple, shares are at 36.2 times, which is below their 3-year average of close to 40 times. So when it comes to Amazon, definitely a stock that I'm keeping in my portfolio. Although from a valuation perspective, I'm not as excited as I was. I'm looking closer to that $200 or lower level to continue to add to my position. How am I doing that? I'm utilizing a cash secured puts. I'm selling puts saying I will gladly purchase this stock at a lower price if it in fact falls again. And if you want to track any of my option plays, then become a subscriber to my Options Edge Plus subscription, which is centered around all of my stock option plays, selling cash secured puts, selling covered calls, buying puts, and doing option spreads as well. And if you want to track my entire portfolio, you can become an Edge Plus subscriber, which is everything stock related from that perspective. Check out those links down in the description below. And that leads us to stock number 4, which is going to be Uber Technology, stock ticker Uber. And again, this is a stock that I've been pounding the table on within my Edge Plus community on Discord around a $60 to $70 range when Uber was trading around there. That's where we added to it and added to it again when the stock dipped. So at current prices though, shares aren't as intriguing as they once were. The company trades out of the industrial sector, and it's been one of the top performing stocks in the S&P 500 in 2025 so far. The company has a market cap of nearly $190 billion, and over the past 12 months, shares are up 35%. Uber shares have been known to be somewhat volatile at times. It seems like they have an aggressive sell-off anytime robo-taxi news comes out. Whether it's related to Waymo, whether it's related to Tesla, it doesn't matter. Shares fall off. Always a great opportunity to buy. And I think a lot of that is overblown. Looking at this chart here, you can see the growth in the number of trips that Uber has done. Mostly made up of mobility trips, but they also do delivery and some freight deliveries as well. As for the financials, revenues continue to grow. The company was able to become free cash flow positive back in 2022 for the first time, and that has been growing every year since, up to $7.8 billion over the trailing 12 months. Taking a peek at valuations here with this Fiscal AI chart, we could see shares of Uber traded an EV to EBITDA of 41.6 times, below their 2-year average of 53 times. Again, those are the only 2 years they've been positive. From a forward PE multiple, shares are at 31.5 times, below their 2-year average of 34.1 times. So when it comes to Uber, I definitely love the stock, and I believe it has huge growth potential moving forward. But when we're talking specifically about 10 top growth stocks for 2025, we only have the back half left. And those gains are going to be much more difficult to come by given what we have already seen. I think Uber can easily get to that $100 level. But when it comes to this list, I'm going to have to find a replacement. And the stock that I'm going to be replacing it with is going to be Marvell Technology, stock ticker MRVL. And when it comes to Marvell, it is yet another AI play. And it's a cheap AI play at that. Let's take a quick peek at valuations here. As you can see on your screen, EV to EBITDA for Marvell trades at 38.2 times, well below the company's 5-year average of 50.2 times. From a forward PE multiple, shares trade at just 24.6 times, again, well below their 5-year average of 31.7 times. And with earnings growth of 78% this year and 27% next year, we are talking about a PEG ratio well below 1, which is very intriguing. So there's our first replacement on the list. And now we're going to move on to stock number 5, which is going to be Alphabet, stock ticker GOOGL. And for those of you that are Edge Plus subscribers and you track my entire portfolio, you know that Alphabet is my largest single stock position. And once we go into valuation here, you're also going to see that it's the cheapest of the Mag 7 stocks. When it comes to Alphabet, they operate out of the communication services sector. They have a market cap of $2.25 trillion, and over the past 12 months, shares are up just 5%. Like Amazon, I like Alphabet for a lot of the same reasons. A diversified business. They have advertising, they have cloud, and yes, they have AI. When it comes to advertising, they own the 2 largest search engines in the world, with Google search as well as YouTube. And YouTube has been gaining steam at a crazy rate. They're giving Netflix a run for those streaming dollars. When it comes to growth, we haven't really seen that much here in 2025 thus far. And by the time this video is published, Alphabet will be publishing their latest earnings results. So if you're not yet in this stock, it might be worth your while waiting to see what those new results are before jumping in. Taking a look here at this Fiscal AI chart, we can see the company's revenues. And this is what you like to see. Consistent growth from all segments of the business. Looking now at valuations, we can see just how low these valuations are, well below all that of the Mag 7 companies. From an EV to EBITDA perspective, shares trade at just 16 times, well below their own 5-year average of 17.7 times. The forward PE sits at 20.4 times, below the company's 2-year average of 21.6 times. From a forward PE multiple, shares trade at just 20.4 times, below the company's 5-year average of 21.6 times. So when it comes to Alphabet, from a valuation perspective, they have a great balance sheet, a great management team, and I believe they're way overdue for growth. So this is a stock that I'm definitely sticking with for the back half of 2025. And that's going to lead us to stock number 6, which is going to be ASML Holdings, stock ticker ASML. And earlier we talked about NVDA being the AI juggernaut, which really paces the AI market from a performance standpoint. But when it comes to where all of this AI stuff begins, it begins here with this company, ASML, and their machinery. You can't build these high-speed, powerful chips really without an ASML machine. The company operates out of the technology sector with a market cap of $284 billion. Over the past 12 months, shares are actually down 23.5%. ASML is a company that flows with a lot of spending numbers that you hear out of these hyperscalers. They obviously flow with a lot of AI news. But one thing that we can all agree on is that when it comes to chips and AI chips, there's a capacity issue out there. That's why the likes of the largest foundry businesses out there, Taiwan Semi, is building more factories, which are going to be loaded with ASML machines. However, last week, the company reported earnings that beat on both the top and bottom lines, but it was the guidance that spooked investors, and I saw that as an opportunity to buy more. As you can see here, I put out this buy alert for Edge Plus subscribers, showing them I was adding to my position. And the company has agreed, as they purchased nearly 30 million worth of shares just last week alone. And when it comes to ASML, you get growing revenues and strong operating margins that sit just shy of 35%. In terms of valuation, EV to EBITDA is at 19.8 times, which is near the lowest we have seen for this stock and well below the company's historical average of 33.2 times. From a forward PE multiple, shares are at 27 times, again well below our historical average of 34.4 times. So as you can see right here, just on valuation alone, you're not having to pay a huge premium. Sure, growth may slow, but it's going to go through its ebbs and flows just like any business out there. So from a valuation perspective, as cheap as shares are right now, this is not a name I can take off of this list. And that's going to lead us to stock number 7, which is going to be Micron, stock ticker MU. And this is yet another AI technology play. And shareholders of Micron have been through a roller coaster ride so far in 2025. As I mentioned, the company operates out of the technology sector with a market cap of $127 billion. And over the past 12 months, shares are actually down 2%. But there's so much more to the results when you zoom out. From their April lows, shares of MU have rallied 75%, which tells you a totally different story. MU is yet another company connected to AI, as they're more on the memory side of things. When it comes to revenues, they're currently sitting at record highs at $33.8 billion, and margins sit at a healthy 22% from an operating perspective. In terms of valuation, MU is an off-year end, meaning they close their books in August. So looking out to August of 2026, analysts are looking for the company to generate EPS of $12.18, which equates to a forward PE multiple of less than 10 at a 9.4 times multiple. Incredibly cheap. Yes, the stock has had a huge run since April, but when we took a step back also, hasn't really moved all that much in the past 12 months. If the AI spending continues and the AI momentum continues, I believe that Micron and their gains are going to continue. That's why we're keeping Micron shares on this list moving forward. And that's going to lead us to stock number 8, which is going to be Caesars Entertainment, stock ticker CZR. Now with Caesars, we're going to take a break from the AI play because they're not much of an AI play. They're more of a consumer discretionary play. They need two main things. They need discretionary spending, which they need a solid job market, and they need wage growth to continue moving forward. But if there's really two areas that I'm concerned about moving forward, it's going to be the consumers. We're starting to see some cracks in the job market. So with that being said, this is going to be a stock that I'm not going to dive deep into because I'm going to tell you right off the bat that it needs to be replaced. And the stock that we're going to be replacing it with is going to be the trade desk, stock ticker TTD. Again, this is a stock that I've been hammering home to those in my Edge Plus Discord community before it had this big run that we have seen, and it just got included to the S&P 500. The trade desk is a digital advertiser, and like Micron, has had a roller coaster of a year thus far. On the year, the stock is down more than 30%, but it has rallied more than 75% since its April lows. And like I mentioned, just got added to the S&P 500, which sent the stock up another leg. However, I believe there's much more run to be had. This stock got hit so hard a few quarters back that I took this as a buying opportunity. But let's see what valuation's telling us. As you can see here, analysts are looking for the company to generate EPS of $2.13 per share next year, which equates to a forward PE multiple of 37.6 times. And that would be a 20% EPS growth year over year. So not a cheap stock by any means, but plenty of high margin growth left. So with that, TTD is going to be my replacement stock for the second half of 2025, replacing Caesars Entertainment. And that's going to bring us to stock number 9, which is going to be SentinelOne, stock ticker S. And if you've been taking any of my stock market update webinars or things like that, you know there's two major themes that I'm focused on for growth. It's going to be AI and cybersecurity. Both of them are going to be huge, but I believe cybersecurity can be as big, if not bigger, than the AI market. And when you talk about cybersecurity companies, you go straight to the likes of CrowdStrike or Palo Alto, but there's a number of other companies that are out there providing different types and protection for cybersecurity. So when it comes to SentinelOne, they operate out of the technology sector. They have a market cap of $6.5 billion, easily the smallest company on the list, so volatility is to be expected. And over the past 12 months, shares are down 13%. But that's not much change from where we're at on a year-to-date basis, as SentinelOne was the second worst performer, trailing only Caesars. However, I have a lot more confidence in the back half for SentinelOne than I do with Caesars. So when it comes to this stock, we are keeping SentinelOne on the list. Revenues for the company continue to grow and are at record highs. The company is still not yet profitable from an operating or EBITDA perspective, so that needs some work, but it's not out of the ordinary for newer companies. SentinelOne was founded in 2013. In terms of valuation, since the company is not profitable, we can't look at earnings metrics. So instead, we're going to look at price to sales. SentinelOne is trading at the lowest price to sales in the history of the company at 6.25. Here, though, is how they stack up to other notable cybersecurity stocks like CrowdStrike, Palo Alto, Zscaler, Okta. And only Okta has a lower price to sales at 5.74. The stock has not yet played out like I was hoping in 2025, but there's still time, and I'm going to stick with them for the back half. I was close to switching them out with Okta because that's a stock that's also cheap and a stock that I'm looking to add to in my portfolio, but I'm going to stick with SentinelOne. And that's going to lead us to stock number 10 on our list, which is Block, stock ticker XYZ. When we actually put the original video together, this actually wasn't their ticker symbol. This was before they changed it. Their ticker symbol at that time was SQ, formerly for their old name in Square. But when it comes to Block, they're a fintech company, but also a unique way to play Bitcoin. The company operates out of the financial sector. They have a market cap of $47 billion, and over the past 12 months, shares are up 14%. Similar to a few other names we've looked at so far, this stock has been through a roller coaster year as well, and it's only July. Shares have traded as low as $44 in mid-April and as high as $99 over the past 12 months. Today, shares trade at $78 and have rebounded more than 55% off those April lows. Not quite as strong as some others, but 55% in 3 months is pretty impressive rebound. Revenues have continued to rise, and the company is looking to consistently turn an operating profit. Margins are still low at 4.6%, but I do expect that to continue moving higher. In terms of valuation, again, no real profits to look at, so we're still using a price to sales metric. And as you can see, shares trade at a paltry 1.5 times compared to a 5-year average of nearly 2. So the big question here is, do I keep them on the list or do I replace them? And the answer is going to be, I'm going to replace them. As much as I like XYZ or Block moving forward, I'm going to switch out with their closest competitor, which is PayPal. And it's a stock that I've added a couple hundred shares to my portfolio moving forward that I'm looking to continue utilizing options with also. And when it comes to PayPal, they already have nice growing revenues, but more importantly, they're also profitable with operating margins sitting at record highs of 18.4%. And from a valuation perspective, they traded a forward PE at just 14.5 times, below their historical average of 16.7. They traded an EV to EBITDA low at 11.8, again below their historical average of 15.8 times. Very cheap valuations. A fintech company in a different sector outside of technology. Another way to play the crypto market as well and not be all in on it. And shares are trading at a cheap valuation. So this is going to be my replacement stock for shares of Block. Although I like both companies, I am going to disclose that I own PayPal and I believe that they're a higher quality company also moving forward. So there's a fresh look at the top 10 growth stocks for 2025. We made a few tweaks. I gave you the performance, which has been quite well, had you just equally invested in all 10 of them. But now we're going to look moving forward, and we're going to go through an earnings season right now that could get things a little bit more volatile. So if you don't yet own any of these stocks, it might be in your best interest to wait until they report their latest earnings because you could get some volatility and an opportunity to buy shares at a lower price. In the comment section below, let me know what you think of my changes. Let me know what you think of my top 10 growth stocks here and what changes would you make. If you haven't done so, please hit that like button down below, subscribe to the channel. It really helps with the growth. Thank you guys so much for the support, and we'll see you in the next one. Take care.